All right, how about this glorious trading range day today? I think anytime you're starting to see lots of sideways bars, like look at here, we basically had a whole hour where the market did nothing but completely overlap prior bars, just over and over again. When you see that, that really sets the tone for the rest of the day. That we're probably going to be a trading range. Strong moves like this are more likely to fail. You see, try to move down, and then try to move down again, both times ultimately failing to break out of this area. So when you're seeing lots of trading range price action, I think most people should just take a back seat and be really patient and wait for breakout to happen. And some days, breakout never does happen. So yeah, you're really limited on the amount of like high quality trades, high quality stop order trades that you can take. But there still were a handful of trade ideas today. So let's look at some of those. One, when you are getting lots of price trading range price action, it's different from days that are trending. When the day is trending, let's look at yesterday's move up. It's very one-sided. You have more gaps. The overlap is less. Right, so it's spending more time doing this and doing this instead of doing this. So when you're instead seeing the market overlapping a lot and a lot more tails on the tops and bottoms, well, just look at the market and see what you could have done to make money. Pretty much any bull bar today, if you would have sold and scaled in, you would have made money. And pretty much any bear bar, if you had bought and then scaled in, you would have made money. So a trading range day is different from what you want to be looking for on a trend day. So a thing with the trading range is that breakouts are less likely to succeed, which means that when you do have strong moves, like strong closes like this, actually what's better to do is to be trying to sell the close and scale in. So imagine breakout bar here. Ultimately what made money is if you sold this close here and then sold higher around these highs and then waited for that to pull back to your first entry here. So that would have looked something like this. Sell here, sell higher, and then wait for that to come back to your first entry. You have a bear bar closing near its low. What some people will do is they'll buy that close, and they never even needed to scale and lower; it just immediately went up from there. And one way to look at this is, what is the total area of the range? So this is the whole range. Are we in the bottom half or the top half? And if you're in the top half, you want to only be looking for shorts. And if you're in the bottom half, you want to only be looking for longs. And it's even better if you can do it in the bottom third or the top third and just leave the middle alone and just avoid all the trades that are right here in the middle. So, what people are doing on this kind of day is they're basically doing the opposite. So they're selling above bars instead of buying, and they're buying below bars instead of selling, because it's more likely that the breakout will fail. Look at this example as we're going down. One idea, maybe if we have this strong close here, this would probably get a little bit more down, so I'd rather not sell this close here. But even if you did, if you sell there, if you buy here, then two ways you can do it. You can buy at a fixed interval lower, like 10 points lower. So then you'd be buying right down here. So that's 10 points lower. And then you buy more lower, and either get out at your midpoint or wait for it to come back up to your entry up here. Another way to do it is buy above a bull bar. So you'd buy this bear close, then buy the bull close, and then get out at your first entry. Generally, I recommend against this because it is difficult for beginners to do. It's easy to get mixed up and to trade too large and to be scaling into too much. And then when the breakout does occur, it can be difficult to manage it correctly. So the key is when you're starting to see lots of overlapping bars and these breakouts failing, you are in a trading range. And the idea with the trading range is that breakouts fail. Maybe like 80% of breakout attempts fail. So attempt here fails, attempt lower fails, attempt lower fails. This is a move up here that failed. So when you're getting that, it is a more of a limit order market. You want to be doing the opposite of whatever the market is doing at that moment. So if you're doing that, make sure you've correctly identified a trading range day, and then trade small so that you are able to scale in and make money that way. If you trade too large, well, then you're risking too much when you try to scale in, and then you end up with this huge position. And then when the market does break out, the 20% of the time that it does break out, then you don't want to be stuck with this position that's so huge, that it just offsets, a month of winners. So that's why you want to, trade small, especially starting out. Make sure you trade in very small, and I would only do that sparingly. So I'd only be, only occasionally trying to take like limit order trades and scale in. It's just an idea for as you get more advanced and get more experience on the charts. A couple swing trades that you like on the 5-minute chart here. We have two marked here. I think this second one is better, and I'll explain why. But looking at the first one, we are below the moving average, and we have a second entry long that's failing, and the second entry long is above this bear bar. So we have a second entry long that's failing below the moving average, and when the market goes there, some people will be shorting there for a swing. So they'll be swinging, trying to go down to the bottom of the range. Now the problem is the probability is lower for taking stop order swing trades like this because we are in a trading range. So any kind of stop orders will just inherently have lower probability. Now this order here, this trade here is better because now it's another attempt by the bears to go lower. So this is a first entry sell, pullback, second entry sell, and second entries are higher probability than a first entry. Another way to look at it is, we could have a double top or a triple top through here, and now we're below the moving average. So for those reasons, I think this is a little bit better of a short. So in a trading range, I would probably normally want to avoid like a first kind of sell like this, like the first time you get a second entry sell, I'd rather wait on that. But then when the bulls try to go up again and then fail again, then good chance the market's going to try to make an attempt lower. So for that reason, I think that's a better sell there. So let's go ahead and look at the 2000 tick chart, and I'm going to start by looking at this range in here. So the range I have marked as these green lines here, and when we're seeing that range form, try to identify early some of the highs and the lows, and at some point you can tell the market continues to try to come back down to this level here, test, keeps testing this lower level here, and then at the same time you can also tell these highs. This is generally where the high of the range is, up here. So when you're starting to get that two-sided market overlapping, lots of overlapping, when you're looking at it, and like on the 5-minute chart, when you get a big bull bar and then sellers are making money, or when you get a big bear bar and buyers are making money, then you want to be thinking that we're in a trading range. And so it's kind of interesting when you're on a, to me, when the market is trending strongly and you go to the 2000 tick chart, you want to be trying to swing. You want to be going for 2 times your risk or 5 times your risk. when you're in the trading range, it's better to try to be scalping. So what that would look like on the tick chart, I had a real good example I wanted to see somewhere here. So a couple examples right here. I'm actually going to mark this like this. So we've been in, look sideways. We've clearly been in this sideways market for a while now. That means instead of a second entry short being a good short and for a swing down, your odds are much lower. So it's actually better to try to do the opposite. So if we look at this, normally we would draw it like this, right? If you're going short, you try to go for 2 times your risk down here. But when the market is having so much two-sided trading and you're in a trading range, these trades that might look good are actually bad trades, and you want to be doing the opposite. So second entry short, but it's a trading range, so you want to be trying to do the opposite. So I would rather be buying below that bar and trying to get out above the top of it. And then my stop is larger than my reward. So it's kind of the inverse of a swing. You're actually going for a scalp. So there are many examples like that through here, almost constantly when you're trying to sell, when normally you would be selling down here. If you're in the bottom half of the range, right? And here is the range. So we're in the bottom half of the range. Instead of selling, it's better to be buying. Similar to, any of these bull bars up here. Instead of trying to buy near the top. I drew that wrong. Instead of trying to buy near the top, it's better to be selling. All right, so I drew it there. So you see like this bull bar near the top of the range. Better to sell above that. Put your stop way above and bet that this range will hold. And then you would get out below it, more near the middle of the range. And so if you've correctly identified a trading range, then this is a great way to do that. Now, when you lose, your losses will be larger than your winners, but the odds of you winning is greater. So that's a positive expected value. And I could mark, so many bars in here. I'll show another one. I can mark this one, but I'll do this. Pull back to the moving average. Bear bar here. Put your stop down here and buy there. Then you see your stop would not have gotten hit, and you would have got out above that bar. So if you're in the lower part of the range, you want to be looking for buys, and you can actually inverse a bear bar or inverse a bull bar. So often if you've correctly identified a trading range, then you can get out with multiple scalps like this before you do end up with a losing trade, and then it breaks out somewhere. If 80% of breakouts fail and only 20% win, then your odds of winning are going to be around 80% because you're betting against the breakout. So if you are risking 2 to make 1, but your odds of winning are 80%, then that's a positive expected value. So we do break out of this little range here, but the day in general is still a trading range. So we still want to have that in mind. Now, I'll pull up the 5-minute. I was thinking that there was a chance at a breakout here after these 3 bars. So these 3 bull bars, I was thinking that there was a decent chance there's going to be a breakout from this. We were still early enough in the day where this might have just been a test lower, an opening range reversal, an opening reversal, just a test lower here. And then we might have gotten a doubling of the range here like this. So I was thinking, and it might have been some sort of cup and handle here, or this would be the cup and then a handle would form somewhere over here. And then the range might double. So I was aware of the possibility of a trading range, a bigger trading range here, but I was looking at the possibility of a breakout happening here. So with those three strong bull bars on the 5-minute chart, that was here. And normally lately I've been talking about when you are above the moving average and you are getting gaps, and you can see we did get a gap here, you want to be looking for trying to get long on the tick chart. And so that's true. However, here we just never really got an entry. I mean, unless you were just straight up buying above one of these bull bars on this breakout, then this isn't good enough of an entry. And then here, I don't know, after two strong bars like that, and then one big bull bar, I would need like a second entry setup here. I don't want to be buying above a big bull bar that's following two strong bear bars like that. Because at this point we're getting near the open of the day, near the highs, and so I would be betting on a breakout at that point, and I don't think my odds would be high enough I don't think this is strong enough to justify buying above that. So I'll stand by the idea of on the 5-minute, when you're getting gaps and strong bull bars, you want to look for entries on the tick chart. There just weren't any real good entries during that. And then basically from there, the rest of the day just was a trading range. And I think it'd be best to try to do what I was saying at the start, and then consider the whole day as the larger trading range. And so the whole range would be something like this. Something in this area. So when you are getting bear bars more near the bottom half, and then bull bars near the top half, then you do want to try to it's actually better to try to inverse those. So I'll draw some examples here. Say we'll do a buy there, buy there. All right, so this is the bottom third of the range here. Let's say let's say you buy below this bar here, and you're betting that we go up here before we go down here. So you would have lost this trade. So that'd be a loser. But then here, you'd have a winner there because it went up first. You'd have a winner here. It never came down to your stop, and you would have gotten out here. And then this would have worked out here if you bought below there, and then buying below here also worked out. So, that's what I'm talking about is one of the difficulties in trading is that not every day is the same. You might have a couple days or a couple weeks that act pretty similarly, and then it changes. And then you just give back everything that you made over those last couple days or couple weeks because you didn't adjust with the market. So, you need the best thing you can do is identify if the day is a trend or a trading range. And probably by 10:30, you need to be saying today's had a lot of sideways price action. The first three bars overlapped, and we did have this little breakout here. Then we just went sideways again, and then continued going sideways. So by that point, you need to be thinking trading range, and be switching that in your mind. And let's say let's say we did get a breakout here in the bull bars, and we did start going higher. Well, then you say, okay, it's not a trading range day anymore, and then we'll adjust to more of a swing trade type of day and try to follow along with the trend. So realize that the market's not going to give you the same setups every day. You need to trade the day that you're given, and then not get upset when it is a different kind of day. Now you'll there's kind of a list of types of days that you'll get. I was talking about it on the daily chart. Our ranges have been much larger lately after this FOMC announcement compared to, pretty much the month of November. We had much smaller ranges. So when you get used to trading that way, and then all of a sudden these ranges expand, then it's like you're in a whole different market and you have to adjust what you're doing. So when that happens, don't get upset by it. Also, don't be afraid that the market's never going to come back to how you prefer it, because it does. You're going to have a few days, few weeks where it's doing something different. So you just adjust to that. And then whatever your preference is, it'll always go back to how you like to trade that. So just make your adjustments and, be hopeful that the market will, give you what you want if you're patient.